Greetings and salutations. My name is Wolfie on Wallstreet, and I'm here today to talk to you about the Mortgage Minute. What does a well-worth know about mortgages? Well, yes, I've primarily spent my time dabbling in gold for the last couple millennia. But the last 35 or 40 years, I've been rather bored with that. We've all heard it before, right? So I've been working in America, working primarily in correspondent lending and wholesale mortgages, trading bonds, etc., etc. So the big question today is, why is it that when the Fed lowers the rate, the mortgage rates don't go down? Why is the Fed lowering the rate, not lower mortgage rates directly? The Federal Reserve does not control rates directly. Instead, these rates are influenced by the bond market, particularly the 10-year Treasury yield. The market exceptions for inflation and economic growth. While the Fed rate cut should ideally lead to mortgage rates being lowered, the actual impact depends upon the market anticipation. If the cut was already expected, it may have little effect. Additionally, if investors anticipate continued inflation, they will demand higher long-term yields, which can offset the Fed's action to keep mortgage rates elevated. Yes! Yes! Gesundheit myself. Is someone wearing Old Spice? Is that good? Go take a shower. My God. Yes! Oh, sorry. The reason that you don't recognize me, obviously, is it's still nighttime and I don't always hold my full form as you see me in the daytime in my normal mortgage practice. Nonetheless, once again, why the Fed cut rate isn't directly linked to mortgage rates. The Fed sets up the fund of rate, not the mortgage rate. The Fed's primary role is to set the benchmark interest rates for overnight lending between banks, not between long-term rates for mortgage. Market anticipation matters more. Lenders and bond vessels closely watch the economic data and Fed pronouncements. If a Fed cut rate is widely anticipated, the market may have already priced it in by lowering mortgage rates in the week before the actual announcement. The factors influencing mortgage rates are bond markets, fixed rate mortgage, which are long-term loans, more close tied to the yields onto long-term bonds like the 10-year note. Inflation expectations. If investors expect inflation to remain high, they'll demand higher yields on their investments to compensate for the decreased purchasing of lowering money power over time, leading to, of course, higher mortgage rates. The economic outlook, the overall strength of the economy, and the expectations for the future growth of all, they also influence bond yields and, consecutively, mortgage rates. But so, to keep why mortgage rate may not lower your mortgage rates, is A, it's already priced in if the market has already expected the rate cut, and rates in anticipation of the Fed announcement might not cause any further significant drops. B, inflation concerns, and if it's cut rates, is seen as a response to a weakened economy. Where inflation risks remain, bond yields might not follow suit significantly. And mortgage rates could even rise, as we've seen in September of 2025. Lastly, investor sentiment. Investor sentiment, uncertainty or negative sentiment in the bond market, independent of the Fed's decision, can cause investors to sell bonds, driving up yields and, at last, mortgage rates. Well, great, Wolfie. What does that all mean? How's that going to help me in the mortgage market? Can you jazz it up a little bit? Put some spice on it? Well, here's the nuts and bolts. The mortgage market is ever changing, right? And it depends upon a lot of things. Stocks diverged on Tuesday on another record-setting day, as Wall Street waited for the first speech from Chair Jerome Powell since the Federal Reserve started cutting interest rates again. The Dow Jones Industrial Average lost around 0.7%. S&P hovered around a flat line. Tech-savvy Nasdaq deposits lost 0.3%. Stocks jumped on Monday to clinch a third straight day of record high closes. Lifted by optimism that the AI trade may envelop their policy easily and continue to fuel a rally for the Nasdaq. Gains as Nvidia stocks start to surge after the chipmaker said it will invest $100 billion, in OpenAI. On the Fed watch side, Powell has scheduled to deliver the speech on monetary policy on Tuesday. In high focus, the policymakers last along with the rates for the first time in 2025. His comments will set the stage for the release on Friday for the Fed's preferred inflation gauge. The personal consumption expenditures on the index, Wallstreet will look for signs that already sticky inflation isn't heating up, which could dent high expectations for 2 more rate reductions this year. The data released on Tuesday shows that the US bank business activity could this month increase, while they measure our prices paid for materials jumped, indicating that price pressures are persisting. Meanwhile, gold, with a lack of confidence in usually treasuries, has of course climbed another fresh record high as optimism for the Fed cuts grows. On the tech side, a spotlight. The spotlight is on Micron technology. Due to after the bell, the memory chip maker results will be matched for a base on AI-driven demand and revenue guidance. With analysts expecting almost 40% jump in sales. In 5 years, at 3.701. The there's a 3.893 in the 10-year is just in at 4.147 as of Tuesday. But the word on the street is the talk of the federal government partisanship, posturing and shutdown as they crack down the discussions. Lenders will definitely be impacted in this month's Strathmore pieces titled "No Lender Wants a Government Shutdown." But just in case, accurately measuring and monitoring business and translations of it always has been focused. And interestingly enough, the number of foreign buyers buying homes in the US has in fact risen. Speaking of which, in the real estate world, giant Compass is set to become the largest residential real estate company in the world after announcing a deal to acquire a major rifle anywhere for $1.6 billion. Compass, which is also operated as Christie's and Sotheby's, will take control of anywhere between any subsidy brand, including Century 21 of again Sotheby's and Coldwell Banker. The all-stock deal values are combined companies at roughly $10 million and will create what is by far the largest residential real estate brokerage in the world. One industry vet wrote me said that one company owns 67% of all of the fuel oil in the US. All bank controls 67% of all deposits. So I'm guessing the DOJ might ask questions, right? With interest rates lowering, more borrowers will be looking forward to securing home finances for any purchase loan. Executed recapture program can help drive opportunities and increase customer value. Developing recapture strategy can be challenging, but if you can optimize these efforts by using your data to uncover opportunities within your portfolio and applying those insights through customer engagement tools, you should be able to have proper balance. These data-driven approach to choose the right channels and at the right time for your customers. We set up for success. Your customers feeling understood, appreciate, and are more likely to come back to you for their next loan. Financial institutions face enormous pressure to do something with AI fast. Rushing into generic tools or control bots won't do. This is a wasted spend for adoption and increased compliance risk. The real opportunity lies in the purpose-built, deeply integrated AI that functions as a true teammate, not just a flashy add-on. And as natural disasters are escalating, driving up cost and straining house affordability, Chief Operating Officer Angela Mulgent explores while increasing regulatory expectations to solve customer challenges and instead highlight market-based approaches that can benefit both industries and homeowners, drawing on insights for the TNBA and the APCIA Resiliency Roundtable. This white paper outlines collaborative, incentive-driven solutions to be resilient and sustainable communities. Natural disasters have escalated in frequency and severity, exacerbating household affording issues across the real estates from 2015 to 2024. The U.S. experienced approximately $190 billion disasters, resulting in over $1.4 trillion in damages and more than 6,300 deaths. This trend, combined with the rising rebuilding costs, insurance premiums, and mortgage-related financial pressures, threatens homeowners and homeowner stability and communities' resilience. This white paper outlines the core problems. These stakeholders' data-driven insights to conflicts and potential solutions for faster private sector incentives for building resilient housing ecosystems. Incentives should be favored on the regulations to encourage resiliency without imposing those mandates and market to those approaches can more effectively denote adoption while minimizing resistance from stakeholders. Consumer education remains essential for widespread adoption, ideally tied to these key moments like buying a home or insurance renewals. Capture attention when individuals are most receptive. However, engaging can vary, undercoursingly with the need to targeted strategies. Ultimately, resilient housing has the potential to stabilize affordability, reducing delinquency rates, and sustain communities in the face of escalating a natural disaster. As autumn begins, Treasury yields nearing the top of their range since the Fed cuts the rate. The 10-year yield is up 10 basis points since September 17th cut, not to mention the 40 basis points higher since the Fed cut the rates and began to ease a cycle over a year ago. Note, Ultimate Blue 30-year mortgage is also claimed 19 basis points over that period. One would think that at the Fed's market could and would be further recalculation this week, with remarks from 14 Fed officials, including Chair Powell, Atlantic Fed President Bostic, and St. Louis President Muslim X expressed skepticism over the week ultimate rates or by the end of the year, adding Huckstone, where the new appointed Fed Governor, Marin, offered to stock interest, suggesting that the appropriate Fed should cut rates, and nearly by 2 percentage points lower than the current levels. Rand's dovish stance failed to influence the markets sentiment and trading session that only largely muted and devoid of notable economic data. With economic data on the tap this week and visible divided FOMCs, yes, it was 11 out of 1 in favor of the 27 cut in basis points. But further members said no further cuts for 2025. The market but to remain exposed to shifting technicals, politicals, developments, than the broader performance of risk assets. We saw to the open this week that the safe haven bid for Treasury has faded. Meanwhile, $211 billion in Treasury options this week on the short term to estimated maturities. They are expected to proceed smoothly given the demand of the market. Today's economic calendar is mostly about the marks in the Federal Reserve, Powell and Bowman, as well as the start of the week month's ends supply. The data starts with Q2 currently account deficit and Philadelphia's Fed non-manufacturing. Redbread brings in the same store stories for the week ending in September S&P Global PMIs, which were manufacturing and servicing treasuries activity that will be headlined by an auction of 69 billion two-year notes. And the aforementioned Fed speakers today is also classed D48 hours MBS. And to begin the day with agency MBS prices roughly unchanged from Monday, it's closed to over the 2-year yield yielding 3.60, 10-year yielding 4.13 after closing yesterday at 4.14%. And that's the Mortgage Minute with Wolfie on Wall Street. We look forward to seeing you next week well, hopefully we will find some more entertaining and engaging news to inspire you. Wolfie moment. Whoop, whoop. Ho, thank you, ladies and gentlemen, for tuning in to Wolfie on Wall Street and the Mortgage Minute. Please remember to subscribe, to like, and to comment. And if you have any questions, please put them in below and we'll see if we can possibly use them in our next segment. Look forward to seeing you soon. And now it's martini time. Next week we bring you a howler. Ow! Night.